consistent. Today, I'll give some more perspective on valuations. Some of you might have gone through our content on this subject in the past, and we'll build on to that. And secondly, also on some of the capital allocation decisions that our portfolio companies have been taking more recently, and what its impact we expect to see on fundamentals of our portfolio companies going forward. So first and foremost on valuations, many of our clients keep asking us about the PE multiples, for instance, which have kept expanding for our portfolio companies over the last, say, 3, 5, 7, 10 years, and hence how do we see valuation or the risk of overvaluation of our portfolio companies. So in that regard, let me first just give some perspective on what we see as the defining criteria of valuations of any company is. So to begin with, non-debatable definition of valuation, according to us, is that the fair value or the intrinsic value of a company is the present value of all expected future free cash flows. In that regard, it becomes then very important to understand the profile of free cash flows that a company is likely to deliver in future. This is a simple chart. Some of you might have seen this in Ashwin Shetty's presentations on Rising Giants and Little Champs. Just to give you some context, so there are 3 phases that are displayed on this chart. The nascent phase of a business is a phase where the operating cash flows are barely good enough to provide for all the capital expenditure requirements. And hence, typically, at the initial stages of a business's evolution, free cash flow generation is pretty much negligible. And hence, you can see the dotted line here, where such companies, despite generating growth in operating profits, might not deliver any free cash flows, because all of the operating profits and hence the operating cash flows are plowed back, reinvested to drive growth through capital investments. So that's typically the stage at which, for instance, most of our companies in the Little Champs portfolio operate. And as these companies become bigger in size, they derive more operating efficiencies, more scale efficiencies. It comes a stage which in this chart is called the growth stage, where operating cash flows are more than the quantum of capex that is needed on an annual basis to provide for growth in future. And since capex is slightly smaller than operating cash flows, this is when the dotted line starts moving above the 0 level, as in the free cash flows become positive pretty much for the first time in the evolution of a business. And because they are coming off a low base, they certainly rise at a very fast rate as capital efficiency improves in the overall business, and hence relatively lower proportions of capital reinvestment are required to fund the same degree of growth, because of which the dotted line has a steeper slope, significantly steeper than the operating cash flows. Right. This is pretty much where let's say the Rising Giants portfolio companies of Marcellus, they sit in their business evolution. And then comes the next stage of a business where the capital intensity required is, let's say, typically 40, 50, 60% of operating cash flows. And this is the stage where a business can sustain for a very long period of time if it retains its competitive advantages, if it keeps adding new revenue growth drivers, if it keeps disrupting its own industry rather than running the risk of getting disrupted from competition or a new technology. If greatness sustains, then the mature phase can be very long. Just to give you some sense, if you look back at history, let's say a firm like an Asian Paints, a firm like a Pidilite has been in this sort of a phase for several decades in the past. Right. There are many other companies and consistent compounders which entered into the matured phase sometime over the last 2 or 3 decades. But yeah, most of these firms over the last 2-3 decades have sustained their presence in the mature phase. Obviously, if a particular business sort of transitions into the decline phase thereafter, where the free cash flows then start sort of moderating, it's a concern. We won't hold these companies in our portfolio, no matter how high their free cash flow generation is. And typically, these companies will be called stagnant companies. They might have high returns on capital employed, but no reinvestment rates and hence weak growth. And that's why this sort of solid line, which is net operating profit for such companies in the decline phase, starts coming down, right? So that's a bit of a context in how we look at cash flow profiles. Now, particularly when it comes to consistent compounders, these are not companies. The consistent compounders are not companies which have transitioned recently from the growth phase to the mature phase, right? These are companies which have remained in the mature phase for several years in the past, and hence, when you look at their free cash flow growth, that free cash flow growth isn't coming because of a sudden sort of jump from zero free cash flows to non-zero free cash flows. It's not the 0 to 1 transition which is leading to free cash flow growth of consistent compounders. That might apply to rising giants in some cases, but not to consistent compounders. Let's just bear that piece in mind. Now, when we look at this, and operating profits obviously is more representative of earnings, profit after tax, etc. And then let's say consider this table. This table has the first 3 columns showing you free cash flow compounding of the last 5 years, 10 years, and 15 years of all constituents of our consistent compounders portfolios. Obviously, for the financials, since free cash flow doesn't make sense as a metric, we've used earnings growth instead. But when you look at free cash flow compounding, on average, there is a good 6 to 7 percentage point gap between free cash flow rate of compounding versus earnings growth, right? So FY 16 to 21, free cash flow compounding of 22% versus 16% earnings growth. That's a good 6% gap between the two numbers. FY 11 to 21, it's 25% versus 19. That's another 6% gap. And for FY 06 to 21, it's 31 versus 25, another 6, right? So it's about 6-7% gap between profit after tax rate of growth and free cash flow growth that these businesses have sustained, right? Why have they done that? I'll come to it in a minute. It's something that we've discussed in our previous webinars. But what impact does it have? What impact does it have on valuation multiples when you look at them, right? The impact is something that sort of this slide tries to exhibit in terms of price to earnings multiples. These are trailing earnings multiples, 1 year trailing for the last 7 years ending FY 21. Why have we ended it at FY 21? A couple of reasons. One, when we compare this against free cash flows, the free cash flows for financial year 21 haven't yet been fully, financial year 22 haven't yet been fully reported. Likewise for earnings, and hence we stopped short at FY 21. But quite interesting when you look at the traffic lights, which represent whether the multiple has expanded significantly in the last 6-7 years or not, right? So red colors indicate, the legend at the bottom will explain it for you. Red colors indicate P multiple expansion of say greater than 30% over the last 7 years. A yellow color would be broadly unchanged P multiple, and a green color would be actually P compression, right? Price to earnings compression. On this slide, you don't really see greens. You see all reds because the P multiples have gone up significantly for all of these companies. And also, just to explain the vertical axis, the y-axis on these charts. So we've rebased the PE multiple to 1.0 for all of these companies in, let's say, FY 15, right? We've done that so that we can clearly see the degree of expansion in PE multiple over the last 6-7 years, right? So just to take an example, whatever was the Asian Paints PE multiple in FY 15, FY 21 PE multiple is roughly 1.4 times that FY 15 multiple, right? Likewise, say a Titan, versus an FY15 multiple, FY21 is 3.5 times, right? So if it was, let's say, a company's PE multiple was, say, 20 times, and it goes to 3 times, that means it is 60 times in FY21. So that's the rebasing done on the vertical axis in order to sort of help comparisons be drawn across all.
Just worth pausing here and saying, at this juncture, a traditional Indian fund manager will say, everything's got really expensive in India, so sell all of this stuff and buy some low quality, telecom or utility or some real estate junk like that, right? So why therefore are we showing our clients this? You might want to just contextualize it.
Sure. Yeah. Thanks, Saurabh. Now, when you say that before you conclude that it's all getting expensive here, let's buy inferior quality companies which might be available at low PE multiples. It's worth just going through this next slide, right? Now, this slide, let me again explain how this slide has been put up. This is price to free cash flow. Free cash flow here has been taken up as the last 5 years cumulative at any point of time. And why have we taken last 5 years cumulative? Because free cash flow tends to be far more lumpy compared to profit after tax, right? Free cash flow, let's say for an Asian Paints, typically would have a 4 or 5 year cycle to it. For a Page Industries, likewise. For a Pidilite, likewise. Nestle, right? Nestle, Pidilite, Asian Paints, Page, these types of companies, they don't do the same degree of capex every year, but they might be generating similar degree of operating cash flows every year. So the free cash flow ends up being very volatile when you compare 1 year versus the next. And hence, when you look at, let's say, 5 year rolling cumulative, so when you look at Asian Paints, FY15 price to free cash flow includes FY11 to 15 cumulative cash flow in the denominator and 31st March 2015 share price. FY16 price to free cash flow includes FY12 to 16 5-year cumulative free cash flow in the denominator and FY16 31st March 2016 share price, right? So that's the way these multiples have been put up, again rebased to 1.0 6-7 years ago, and the trend is then carried on till FY21 in these charts. Quite interestingly, all green lights, barring, let's say, a Divi's Lab here. Almost all of these companies, they've had pretty much either no expansion in price to free cash flow, or in fact a compression in their price to free cash flow multiples, right? Now, to the extent that free cash flow is the defining metric for valuing a company, right? As I started off by saying, is the present value of all expected future cash flows, which defines the intrinsic value or fair value of a company. To the extent that that's the non-debatable definition worth sticking on to, price to free cash flow multiple becomes a very relevant one, right? You inverse it, you reverse it, and it is the free cash flow yield that we're talking about here, right? Now, the free cash flow yield or the price to free cash flow has not changed much. In fact, has fallen off for some of these companies over the last 5-6 years, the P by FCF multiple, right? Which means that these companies have not become more expensive today than they were 3, 5, 7 years ago. They are pretty much as expensive as they were 3, 5, 7 years ago. And mind you, I'm taking FY21 because over the last 12 months, somebody might argue that, look, share prices have fallen because we were sitting at expensive valuations in FY21 for, say, a Dr. Lal Path Labs or for, say, some other company. That's actually not the case, right? So that's one point worth understanding very clearly, that these multiples haven't expanded. Now, why have they not expanded? Again, or rather, before I go to that, this is for the financial stocks, right? So the previous slides had only non-financials where free cash flow as a metric was used. For financials, obviously, earnings growth is a far better measure of the cash that these businesses generate. And there again, I mean, Bajaj Finance, certainly, yes, it slowed down its rates of disbursements, and it has a relatively short tail book, and hence there was an earnings dip in the COVID times that Bajaj Finance underwent. because of which obviously the PE multiple looks much higher in FY21 exit on this chart. But barring that COVID effect, even a Bajaj Finance, or for that matter any other company here, has not seen a significant expansion in the PE multiples in the financial sector, right? Now, because of that, you see combining the price to free cash flow and price to earnings multiples for non-financials, you see a jaw opening up, right? The dotted line is PE multiple, the solid line is price to free cash flow. And pretty much for every company here, you see a jaw opening up over the last 5, 6, 7 years, right? Where PE multiples have run up far ahead of price to free cash flow multiples. And again, reiterating why has that happened? It's largely because of this 6 to 7% gap between the rate at which free cash flow compounding has happened versus the rate at which earnings compounding has happened. Again, just to reiterate, this is not because till 5 years ago, these companies were not generating any free cash flow, and of a low base, their free cash flow has expanded at a much faster rate. Even 10 years ago, they had a massive gap between free cash flow compounding and earnings. Even 15 years ago, they had a massive gap between free cash flow compounding and earnings, right? So that's at an overall level. In our previous webinars, we've articulated how you can understand that in a waterfall chart for specific companies. So let's say this is Asian Paints. Their earnings is largely the combination of first two bars. The first bar is sales growth. The second bar is operating margin expansion. You combine these two together, it's profit after tax growth, which, say for instance for Asian Paints in the last 15 years has been around 18%. So 14 plus 4. Obviously, this has a compounded effect, so it might be actually 14 and 4 might be 18 and a half. So don't add up and please think why is it not adding up to 27? Because this is compounded addition. This is not simple addition, right? So 14 plus 4, that's the profit after tax growth summation of the first two bars. But more importantly, that's not where the story ends in free cash flow generation. There is a consistent drop in working capital cycles of Asian Paints. There's a consistent increase in asset turnover of Asian Paints, which is the decrease in capex to CFO bar, second last bar that you see on this chart, right? These are operating efficiencies beyond profit and loss account, beyond the income statement. These are operating efficiencies which drive free cash flow to a higher level than earnings, because these operating efficiencies don't benefit profit after tax on the P&L, but they do benefit free cash generation. Provided a company can consistently keep reducing its working capital cycle for the next, say, 5, 10 years, or consistently keep increasing asset turnover for the next 5, 10 years, you will see this gap between free cash flow and profits sustain. If this gap sustains, you can now make out what will happen to the PE multiple, where the numerator gets pulled up by free cash flow at a higher rate than the denominator, which is a lagged number of profitability, right? Likewise for a Titan, here it's a slightly different combination of working capital and asset turn. Here it's more working capital expansion than asset turn expansion. Sorry, more working capital reduction than asset turn expansion, which is driving the gap between profit after tax growth and free cash flow growth, right? So that's on Titan, and this is Page Industries. Again, they've been very, very consistent in investing to reduce the working capital, the inventory days. More recent initiatives around automation of their entire front end with auto replenishment systems and sort of demand forecasting using Blue Yonder, etc. All of that will further reduce inventory days if executed successfully, and that will lead to the gap between profit after tax and free cash flow growth rates sustain for several years to come as well, right? Now, just to remind everybody in terms of absolute valuation, right? So far, all of that PE multiple, the progression of PE multiples, the price to free cash flow multiple and its progression is a relative multiple effect. You are comparing today's multiples relative to where they were 5 years ago. You might be comparing today's multiples with some other companies is multiple, so on and so forth. When it comes to absolute valuation, as in, is the current price to free cash flow or price to earnings multiple of a particular company in an absolute way undervalued or overvalued, and at what level does it become fairly valued or overvalued? It's very important to sort of conceptualize the longevity aspect of a business in a discounted cash flow approach, right? So this is the slide. Some of you might have seen it in our previous webinars, newsletters, presentations, etc., where if you pick up three companies, right? Scenario 1, scenario 2, and scenario 3 are three distinct companies, let's say. If you pick up three different companies, all of those companies have the ability to compound their earnings or free cash flows at, say, 25% CAGR, right? But the difference is in their ability to compound that without much of uncertainty or with a lot of uncertainty into the future. A company which has a lot of uncertainty to its rate of compounding will have limited longevity. So let's say scenario 1, 5 years, versus another company which has a lot less uncertainty to its compounding of fundamentals, will have greater longevity, let's say 15 or 25 years, right? When you compare across these companies, the fair value, right? The fair value, it is a significant multiplier effect with increase in longevity to the fair value of these businesses, right? So scenario 1, where 25 years of 25% rate of compounding sustains only for, let's say, 5 years, and then has to be sort of moderated in assumptions to a much lower number. For such a company, the sort of fair value PE multiple will not be more than 24, 25 times. Whereas for scenario 3, if you are convinced as an analyst, as an investor, if you are convinced that the 25% rate of compounding will not drop down to a very low number very soon, and if you think that it will be several decades before which this can stop, then the fair value PE multiple can literally be a 10 times higher number compared to scenario 1, right? So that's something worth bearing in mind, the power of longevity of growth, which an analyst needs to, an investor needs to factor into their expectations. Now, what drives longevity, right? Again, just to summarize, what drives longevity? It's the ability of a company to convince an investor that competition is not a risk which will so easily play out in stopping the compounding of free cash flows, right? That's more about the moat. That's more about the pricing part. Can a competitor overnight put brakes on the rate of free cash flow compounding, and should we bake that into our expectations very soon into the future, right? Another area is lethargy, is capital misallocation. It could be capital misallocation around say the existing business and deepening its own strengths. It could be around adding new revenue road drivers, and hence the risk of saturation in the current core once your market share starts crossing 60, 70, 80%, or once the overall industry matures, saturates, penetration is sort of near 100, and hence the growth rate stagnates. Or it could be the risk of disruption, where capital hasn't been allocated enough to defend against disruption, or capital hasn't been allocated to disrupt your own competition, right? So that's the capital allocation risk. Under lethargy score, we measure that in our longevity framework. And the third risk is around management, right? Quality of decision making should have continuity to it. Quality of decision making should have scalability to it. That continuity and scalability in high quality decision making is provided by an independent board, a high quality management with great succession planning processes, and systems and processes to run the business at a ground level in a very decentralized manner, right? So that in effect is a combination of all the risk mitigants that you can put in. If a business has high quality risk mitigants across all of these three verticals, then the longevity can be much higher, much greater, and the fair valuation can be a significantly higher number compared to, let's say, just a 40, 50, 60 times PE multiple or a little higher, right? So that's worth bearing in mind. And in that regard now, worth understanding in our existing CCP companies, in our existing consistent compounder companies portfolio, what are we seeing by means of capital allocation, which gives us the conviction that that efforts are being made to sustain greatness for much longer than what say a mediocre quality company would, and hence what gives us the confidence around sustained longevity of our business as time progresses, right? So this, you might remember in the last month's webinar, we presented how fundamentals of our portfolio companies are compounding at rates much higher than what they used to be prior to COVID, right? So this is the 2-year revenue CAGR for the December 21 quarter. It is a much higher degree of growth than what we saw till a couple of quarters ago, or particularly than what we saw during, say, FY 14 to 19 or 15 to 19 or any other period prior to COVID, right? So it's an accelerated variant of growth that we are witnessing now. Even for the lenders, when you look at the quarter-on-quarter annualized rate of loan book growth, it's a far more accelerated version, right? For instance, an HDFC Bank reported in the quarter of March more than 30% annualized sequential growth in its loan book, right? So that's all happening because of market share gains progressing in an accelerated manner, right? So these three tables, diagnostics on the top right, paints on the top left, and the lenders, you can see the encircled part suggesting how the gap between listed competitors and our portfolio companies has opened up in a much wider way over the last few quarters, right? This is market share gain of an accelerated variant. Why is it happening? Largely, I mean, these are some of the capital allocation decisions that our portfolio companies have taken. 3 types of them. First is an acquisition. So in many of these bubbles, you would see acquisition event being carried out over the last 2 years, right? So Asian Paints, I think last week announced a couple of acquisitions to strengthen its home decor business. Pidilite acquired Araldite a year and a half ago. Page Industries, Dr. Lal Path Labs acquired Suburban. ILOM, HDFC Life, etc. acquired smaller books, and that's basically strengthening the runway of growth through sort of new geography of Dr. Lal, through Suburban, through new category of home decor for Asian Paints, through Araldite acquisition of a Pidilite where Pidilite was not a leader previously, so on and so forth, right? So that's one type. The second type of capital allocation decision is tech investments, whether it be let's say Pidilite's auto replenishment system, Page Industries is auto replenishment system, complete automation of their plants in the case of a Pidilite, a Nestle, Page Industries. When it comes to, say, HDFC Bank, investments made to improve upon some of the tech-oriented aspects which it used to lag behind significantly versus some of its competitors. Bajaj Finance transitioning into a fintech company from just being a lender. Dr. Lal Path Labs using home collection infrastructure in tier 2-3 cities to expand, so on and so forth, right? So these are the kinds of capital allocation decisions which have happened in a much more accelerated manner over the last couple of years, because the crisis gives many opportunities, which sort of increases our confidence in the longevity of these businesses, and hence their fair values are much higher than the current share prices, right? So that's on the capital allocation decisions. Now, very quickly, some of you, I'm sure, will be asking, but the share prices of these companies haven't moved in the recent past, right? So very quick understanding on how fundamentals might have progressed for the companies where share prices haven't moved. If you look at these tables, these are 4 private sector banks. Advances growth is loan book growth. And you can see Bank 2 has had the fastest rate of loan book growth in the last 1 year, 3 year, 5-year time period across these 4 banks, right? Likewise for deposits, right? For the last 3 years, 5 years, Bank 2 has had the fastest rate of deposit growth. Just in case you can't make out which is Bank 2 has also had the best quality of assets on its balance sheet, and market share gains have been the most profound in the case of Bank 2 versus, say, Bank 1, 3, and 4. Interestingly, Bank 2 is HDFC Bank, and its share price hasn't moved much compared to some of the other banks in these tables, right? So fundamentals have progressed. Share price hasn't. It's taking a holiday. But because fundamentals are holding up quite strongly, we remain convinced about the future. This is about an insurer where insurer 1, you can see the annual premium equivalent has grown at pretty much the fastest pace over the last 3-5 years. The embedded value, which is the equivalent of, say, a book value of a non-insurance company, embedded value growth has been the fastest over the last 1, 3, 5 years. So has been their return on embedded value and market share gain, right? Market share gain of insurer 1 has been the fastest. You can see over the last roughly 5 years, right? This is HDFC Life, and its share price is down by about 10% over the last 12 months, right? And finally, this is another company in our portfolio, which has 3 listed competitors. All those 3 listed competitors have had a much slower pace of core business growth, quarter after quarter after quarter, right? And this firm has also acquired a business recently, massively expanding its base. But yeah, this is Dr. Lal PathLabs. Its share price was down, I think 40-45% a few weeks ago. Now it might be down some 25-30% compared to where it was maybe roughly a year ago, right? So fundamentals of these companies have compounded at a rate which gives us a lot of confidence. And these companies have made capital allocation decisions, which adds on to the longevity of these businesses into the future. Their PE multiples are not the ones to look at. When you look at price to cash flow, that's where there is no expansion, and hence the question that is the weak share price of the last 12 months representative of overvaluation 12 months ago? That's actually not the case, and hence we remain convinced, holding on to these companies in our portfolio. Last 1 year, we've completed another financial year. Last 1 year, post fees and expenses performance has been around 15%. It's a decent number on an absolute basis, given that we've had a little bit of a correction in the portfolio NAV more recently. It's not a bad outcome of 15%, and in the long run, it's a sort of 22-23% sustained, which is pretty much what we would like to see as the rate at which share prices track fundamentals of these portfolio companies. And when you talk about last 6 months is underperformance, the chart on the left is the Nifty50 constituents in the index and their 6-month share price performance. Chart on the right is our portfolio companies. You can see on top, our portfolio companies broadly have underperformed as a whole by around 7 percentage points versus Nifty50, but that's all because half of Nifty50, which has delivered a positive share price return, consists of the list of companies, and you can go through this list. These are companies which we won't want to own in our portfolio. These are utilities, commodities with weak fundamentals, and hence not the kinds who would compound fundamentals and sustain their share price progression in a buy and hold fashion. And companies which we hold in the portfolio, their share prices have corrected for non-fundamental reasons, and as long as these are non-fundamental reasons, they all end up being temporary, and we expect reversion to the mean being the rate at which their fundamentals compound, right, in the future. So that's on the last 6 months, very similar to what happened during demonetization. We had showed this slide in our previous webinar as well. During demonetization, a very similar outcome of utilities and commodities lifting Nifty50 up, leading to a good 8-9% alpha of Nifty over our portfolio during the portfolio companies during that period, because none of our portfolio companies actually delivered a positive return. And what did deliver a positive return for the index during those 4 months of demonetization was was not the pack of companies which we would hold in a portfolio of consistent compounders. Just giving you a broad picture on the underperformance piece here. So this is a chart from Diamonds in the Dust, our most recent book. Some of you might have already read it. This is Exhibit 80 in Diamonds in the Dust. The chart basically shows you 12-month performance of the sort of coffee can portfolio that was there in coffee can investing, or the sort of portfolios that we had there, where x-axis of the chart is the start date of the 1 year period, right? And it's a rolling 12-month performance on that basis, right? The vertical bars that you see, if they are standing above the zero line, it means outperformance. If they are hanging below the zero line, it means underperformance. And Sensex is the blue line, and the returns of say Rob Kirby's investing approach, right, is the black line. Now, quite interestingly, over the last say 20 odd years, there have been several instances. So if you can see my mouse cursor, somewhere in 2002, between 2005 and 7, the green bars are hanging down, right? The portfolio of Rob Kirby is underperforming Sensex during all of these years, 2012, 13 again, 2018, 19 again, right? So there are several instances where such high quality portfolios, they do underperform. These instances always tend to be temporary, and the reason for that period being temporary is because the underlying fundamental growth of a Sensex is far weaker than the underlying fundamental growth of a Kirby's investing approach, which ends up leading to better long-term CAGRs of high quality portfolios eventually. So that's where I'll stop. Pramod, we can take some questions maybe.
Sure, Sakshit. So we have one question around free cash flows. The question is around if they're a company which has a very high reinvestment rate, something that we prefer for a prolonged period of time, it may not be generating free cash flows. How do you then factor that into your price to free cash flow based valuation, or in your DCF valuation?
Very good question, and this is the question. In effect, what you're asking is if there is a company in the nascent phase, right, in the nascent phase where rate of reinvestment is very high and hence free cash flow is negligible or negative, how do you value it, right? So look, eventually for an investor to make money out of investment in a business, the business has to generate positive free cash flow in future, right? If a company perpetually remains zero free cash flow generative because it has to fund all of its capex from entirely operating cash flows, and there's no surplus left after that reinvestment, there's no free cash that the business is really generating. Either it should not grow, or it should grow and not generate any cash. In that sort of company, in any case, an investor won't make money. So when you're investing in a business which doesn't generate free cash flow, what's important is to understand two aspects of it. Is it not generating free cash flow whilst also having high pricing power, right? If yes, then the next question is the capital reinvestment rate, which is high, likely to bring in operating efficiencies in capital investment in future or not, right? Is the capital reinvestment likely to remain inefficient forever, or can we see some efficiencies emerge in future? Is the company capable of using technology to its benefit? Are there scale advantages that might kick in future, right? So on and so forth. The answer to these questions will give you a sense of two things. One, will the return on capital employed sustain, right? Return on capital employed has to sustain for free cash flow to be generated in future to begin with. And two, will capital efficiencies increase? Will operating efficiencies increase? If you can see operating efficiencies increase, either because of the sort of tech investments or scale advantages or as the business learns more and more about the customer, it can run its business in a more efficient way to serve that customer, so on and so forth. If you can get answers to those questions, then it becomes easier to foresee free cash flow generation in future. And that's pretty much where you have to foresee the growth phase and the mature phase of a business, even though current business phase is a nascent phase, right? So that's in a way answering your question, and it's harder than just forecasting earnings growth for the next 3 to 5 years, which is why it's more rewarding when everybody else can easily forecast earnings growth for the next 3 years, but very few investors with very deep insights might be able to forecast free cash flow growth better.
I think just to sort of expand on that, I think Rakshit, you're being a little polite here, right? The vast majority of the Nifty companies have been around for decades, right? So by no stretch of the imagination on this chart can we say that the Nifty companies are either in the nascent phase or in the growth phase. The vast majority of the Nifty companies are supposed to be mature. They've been around for decades, right? And if we look at these companies, the vast majority, 70% of the Nifty companies, say every telecom company, every metals and mining company, every real estate developer in our country, every power and infrastructure company. These companies have been around for decades. They are mature by every logical definition. Yet they don't generate a cent, a rupee, a dime of free cash flow decade after decade, right? So the big concern for those of you who are listening to us today is not that Asian Paints is compounding free cash flows at 25%. It is, and that's should be a source of great profit and satisfaction to you, to us, a Titan, a Pidilite, an Asian Paints. They're not only reinvesting heavily, they are, in spite of the reinvesting, compounding the free cash flows at 25%, which is a remarkable feat. The concern for those of you who are listening today should be that the vast majority of the Indian stock market, 70% of the Nifty, these are companies who are matured by every sense of the word. They generate modest operating cash flows. When, say, the commodities cycle is hot, they generate stronger operating cash flows, but they manage to fritter it away so comprehensively that rarely do they go through a decadal period where they generate free cash flow, forget about growth in free cash flow. And that becomes a pretty challenging situation if that's how the core of the stock market is run. What that does is it results in the typical Indian fund manager not focusing on free cash flow, because the poor guy simply doesn't have companies in his portfolio who generate free cash flow, right? So the fund manager ends up focusing on PAT because that's all he can talk about. That's all is there to show. But what it should result in you and me asking these people, these fund managers who invest in conventional large cap companies, is, if you're investing in companies, sir, which don't generate cash decade after decade, how will you make money for me? How will that company make money for itself? Right? That actually becomes the most troublesome question at the heart of conventional investing in India. Our response has been, as Rakshit has beautifully laid it out, our response has been, we do the reverse. We look for companies who consistently grow free cash flows at 25%. Not only do they have positive free cash flow, they grow that number. How do they grow that number? They don't just grow that number because of GDP growth. They grow that number because they reinvest surpluses in the business, in technology, as Rakshit explained, in sensible acquisitions, in growing distribution, in growing their factories, in growing their product set. Right? And that is the only sensible way we can compound our wealth, rather than investing for decades on an end in telecom companies, which never generate cash. And still there's this perpetual hope that this will amount to something one day. That doesn't work. It doesn't make any rational sense.
Yeah, that's quite an important piece. You can have zero free cash flows, not just as a nascent company. You can also have zero free cash flows as a mature company, and that combination of matured company, zero free cash flow, is actually a disaster.
Equally, the other way, I guess, Rakshit, if a company stops reinvesting and throws out a lot of free cash flow, you might see the price to free cash flow, the free cash flow yield, very attractive.
Correct.
That's equally faulty approach.
Correct. It's equally faulty, right? So take, for instance, examples such as, say, a Castrol, Colgate, ITC, right? An ITC till 6 years ago used to reinvest 40% of the operating cash flows. right? Today, that number is far, far lower. And hence its free cash flows has compounded at a very healthy rate over the last 5 years. So you got to look at two things happening in tandem. You can actually make a 2x2 matrix: high rate of reinvestment and high free cash flow generation. This is what makes money for an investor. Dropping rate of reinvestment and hence high rate of free cash flows is the start of lethargy, the start of slow growth phase, and that will lead to lower rate of returns for an investor. High rate of reinvestment, low free cash flows. If it happens with a matured company, it means there's some low pricing power challenge or some other challenge, because of which, even though the firm is matured and it is reinvesting cash at a high rate, it can't generate free cash flows. That's not going to make money for investors. And obviously, low rate of reinvestment and low rate of reinvestment and free cash flows also being low is obviously not going to make money for investors. So that's a very nice way to put it, Pramod.
So here's an interesting question in terms of the market perception, right? We were right in terms of showing those 3 stages of DCF, where the longevity drives a high PE multiple. Given what we know of the market, given most market participants tend to be sort of short-term oriented, they will never be able to appreciate the longevity in the first place. And therefore, even if you justify, say, a 70 times PE as very attractive, given its fair value PE is 245, if the market never gets to appreciate that it's actually 245, you may never be able to bridge the gap between the current PE and the fair value PE. In other words, somebody else has asked a similar question. So the fact that you've shown that in the last 3 years, HDFC Bank has done phenomenally well in terms of fundamentals, yet the share price hasn't gone anywhere. Does that mean that the market is already factoring in these the strength of the fundamentals, and therefore you've already bought the stock at a fair price? I mean, two are not exactly related, but I thought it's best to tackle both of them together.
Yeah, sure. So answering the first part of the question, and it's very nicely articulated question. Answering the first part of the question, so there are 2 drivers of share price growth that an investor can expect. One is the fundamentals themselves grow, and the second is the multiple expands towards where its fair value might be if it is an undervalued company, right? Now, these 2 drivers can apply to a company which could be high quality, low quality, in the same mathematical manner. So, for instance, there can be a company where fair value PE multiple is 10 times, current PE multiple is 5 times, and there is no growth in the earnings, right? Or if it's price to free cash flow multiple you're looking at, let's use 5 times, 10 times, and no growth in free cash flow. For such a company, an investor is largely looking for price to cash multiple expansion or price to earnings multiple expansion as the driver of share price returns. Because if the price to earnings multiple doesn't go up, if it doesn't move to its fair value PE, then there are no returns to be had, right? Likewise, for the consistent compounders, there are 2 drivers. One is if they keep compounding free cash flow at 20-25% CAGR, and if their fair value PE multiple is, let's say, 3 times or 4 times higher than their current PE multiple, right? Then you can expect share price progression from 2 factors. One, you hold on to these companies and their free cash flow compounds, which drives your share price upwards. Second, you hold on to these companies and their PE multiple or price to free cash flow multiple reaches its fair value during our investment period, and that drives your share prices, right? What we are at Marcellus more interested in is in the former, because the latter is not something that we can foresee so easily and in a consistent way. The latter being PE multiple or price to free cash flow multiple expansion to its fair value multiple. That part is difficult to foresee. It's difficult to forecast in a consistent manner. What is easy to forecast is the fundamental rate of growth. If it is healthy enough to give you the desired rate of compounding from the investment that you expect, then a consistent compounder gives you compounding without the need to rely on multiple expansion, right? In which case, let the fair value be high always. Let the share price remain undervalued always. You'll keep compounding basis fundamental rate of growth, right? So that's the answer to the first question. Hence, we are not worried that today our portfolio companies are undervalued according to us. 10 years out, they might remain undervalued because the market doesn't factor in longevity adequately enough, because we are not playing multiple expansion as a driver of growth in our investments. We are doing the fundamental compounding as a driver of growth in our investments. Right now, combining this with the second part of the question, so you're perfectly right. Logically, what has happened to, say, HDFC Bank through that example is its P multiple has compressed, right? And you can actually see it here. From FY19 to FY20, HDFC Bank's P multiple compressed. FY21, it's somewhere, if we extrapolate this HDFC Bank chart to FY22, the PE multiple has compressed, right? That is the case how multiples have moved in the last 5, 6, 7 years for pretty much every company. Look at Titan, goes up, down, up, down, up, down, right? The PE multiple does compress at times. What we are interested is in a healthy enough rate of fundamental growth, so that even if the PE multiple compresses for, say, 6 months or 12 months, over a 2, 3, 4 year period of your investment, you get a decent enough rate of share price compounding.
Rakshit, let me try to explain why neither you nor me nor anybody listening needs to worry about the PE multiple, right? So let's assume for a minute, folks, that nobody else in India watches this video. Everybody carries on saying PE multiples is the way to value companies, and they say free cash flow kisko pata hai, PE is the way to go. And let's take an example. Let's see, say Dr. Lal Path Labs. Right, Dr. Lal Path Labs on price to free cash flow. Let's just go to the price to free cash flow chart in Dr. Lal. So I think the other, yeah. So on PE multiple, Dr. Lal has gone up, but price to free cash flow pay, Dr. Lal Path Labs is pretty much where it is. But hey, nobody looks at that, so everybody starts jumping up and down that it's expensive. Now, does Om Manchanda, the Dr. Lal Path Labs CEO, lose any sleep about it? No, he doesn't. Why doesn't he lose sleep about it is actually quite important to understand. Right? It's really important to understand why the people running Dr. Lal, and I'm using this example for a deliberate reason, why the CEO of Dr. Lal Path Labs won't worry about the PE multiple. Neither will Rakshit, nor will I, nor should you. Why shouldn't he worry? Right? What Om knows is he's running a highly cash generative business where the free cash flows are very strong. ROCs, I think, are pushing. Rakshit, ROC is pushing 70-80%. Or ROIC.
Yes,
if you take out
ROIC pushing north of 100.
Right.
CE so, more like 30-40%.
So the Om knows that the business is generating a lot of cash, right? Om also knows that the market looks at P and the market doesn't look at cash. So Om knows that on P, the market's pushing the P multiple up, but Om won't worry. Why? Because he knows that his balance sheet is getting loaded up with cash, right? Cash is what Om cares about. Why does he care about cash? Because with that cash, he can grow the business. He can invest in technology as he's done. He can come and buy Suburban Diagnostics in Bombay, become the second largest player in Bombay for 950 crores as he's done. If he uses that cash sensibly, Om knows that with that cash today, he can generate profits tomorrow. Om is perfectly happy to say, boss, judge me on PE for the next 250 years. But he knows that with his cash and with his capital allocation skills, with his competitive advantages, he will use today's cash to generate tomorrow's profit. And when tomorrow the profit comes, the market will say, "Badhiya boss, Dr. Lal ka pat chad gaya, chala do share price chala do." Some analysts will write, "Overweight Dr. Lal Suburban acquisition synergies working out." Right? So today's cash is tomorrow's profit. So if you really care about making money, the reason you should look at cash is today's cash in the hands of a smart promoter is tomorrow's PAT, right? So by all means, let's carry on with the mental model that the market focuses on PE. We shouldn't have a problem with that. Let the market focus on PE, right? Because after all, we can't expect the retail investor in Ghaziabad to watch this, watch this YouTube webinar and shift to price to cash flow. Calculate bhi nahi kar payega. So let them do PE. But our job, your job, is to focus on companies who are generating surplus cash, reinvesting that intelligently to generate generate growth, rapid growth in PE, rapid growth in EPS over the next 3, 4, 5 years, so that your and my investments become higher in value. So focus on PE, there's no problem, but understand that the ability to generate cash today is equivalent to generating profits tomorrow. Companies that don't generate cash today, which is the vast majority of the stock market, will struggle to generate profits tomorrow.
So just as a corollary of that, just completing the point on HDFC Bank, if HDFC Bank's fundamentals remain healthy over the last 3 years, yet the stock price has given suboptimal results, how long do we expect, and I think somebody's got on the point that we've talked about stocks going on holidays, how long do we expect this sort of divergence between fundamentals and stock prices to remain? How long does it take for the stock price to converge to fundamentals?
So, I mean, this chart has some way to answer that. So you can see Pidilite, FY15 to 17, the multiple kept going down. And the share price actually didn't do much during those 2 years, if you look at the share price chart. Dr. Lal Path Labs, right? It listed sometime in, I think, FY16 or FY16 end pretty much at around 1,000 rupees a share. And till the middle of 2019, Dr. Lal was at 1,000 rupees a share. It was actually 800 rupees a share by the time FY19 ended. So for a 3-year long period, Dr. Lal's share price didn't move anywhere. Free cash flow kept going up, which is why the PE multiple literally almost halved. Right? During those 3 years, you can see the bottom right chart, Dr. Lal's PE multiple literally halved. But then when it got back up, you can call it mean reversion, where, as I said, mean is fundamentals, free cash flows. When it got back up, it went back up at a very rapid pace. So this in a way is sort of indicative of maybe what might happen to most companies whose share prices go on a holiday. The reason why we build a portfolio is because in the portfolio, companies will go on a holiday together, right? At any point of time, barring maybe 2-3 companies, rest of them will be working towards making money for the investors, and hence, I mean, it's not such a big worry that an HDFC Bank hasn't delivered much, because the overall portfolio will deliver. When if an HDFC Bank is on a holiday, then the Titan has more than compensated for HDFC Bank's holiday in the portfolio. Right. So we don't know exact answer whether it will be 1.5 years or 2 years or 3 years, 1 month, etc. But yeah, these dislocations cannot continue for too long, beyond a couple of years in most cases.
Fair enough. So, I mean, just catching on to your point on the reason for having a diversified portfolio to avoid effects of stocks going on holiday, there is a separate elaborate question on diversification. Why, if you have such stocks in the portfolio, which tend to be pretty much well appreciated by the market, at least in terms of valuation terms, would you rather not have a more diversified portfolio than a 15 stock portfolio? So therefore, even if a few stocks go on stock holiday, the chances that there are several others who will pull it up is better. How do we justify the concentrated nature of our portfolio?
Sure. No, very good question again. So let me answer it using this table, right? The bottommost row that you see, weighted average, right? If this number falls because of increase in the list of stocks in the portfolio, that's a bad outcome, right? So what are we really diversifying as a risk in our portfolio? It's not just share prices going on holidays and hence we want a longer list. It's also not, say, the broader stock market leading to at times commodities and utilities do better than high quality companies. At other times, high quality companies do better than utilities and commodities. it's not those risks only that you need to worry about through the lens of diversification. It's also the risk that what happens to this table if you diversify. There aren't enough number of companies available in the listed universe where a 40 stock portfolio of consistent compounders will deliver 25% rate of free cash flow compounding, regardless of what is happening in the external environment. Remember, last 5 years was incredibly disruptive. The FY 16 to 21 that you see here, the first column, was incredibly disruptive. Demonetization, GST introduction, COVID, island FS crisis, it's all in there. It's all in that 4 or 5 year period packed together. And still, this list delivered a weighted average free cash flow compounding of 22%. If we increase the list to 30, 40, 50 companies, then the 22% will drop down to mid-teens at best. That's a massive drag on the outcome that an investor might want from a portfolio. You will certainly have avoided, in a 50 stock portfolio, would have avoided the degree of underperformance that our portfolio saw in the last 6 months versus Nifty or Sensex maybe, but you won't have compounded at a healthy rate in the longer run, right? So that's I think worth understanding.
I think one real world analogy, I think every year when the Olympics, sorry, every 4 years when the Olympics happen, right? We sort of see a huge Indian contingent go to the Olympics. There's hundreds of people from India rock up in the Olympics. And I think we get one gold perhaps every 10 years or something, right? So we get one gold at Olympics. Jamaica sends a small team, I think a few dozen people, and they typically come away from a typical Olympic event with 3 golds. So the goal here is not to sort of have a 40 stock portfolio with free cash flow compounding of 15%. A 40 stock portfolio, Rakshit, I think we'll diversify every risk. We'll have commodities, we'll have real estate, we'll have power and infrastructure, we'll have public sector banks, we'll have metals and mining, all of that stuff. We'll have diversified away risk. We'll also have diversified away your return. And I don't think then, 350 of you would be dialing in to listen to us explain to you how we have diversified away your return. So that's how modern Indian fund management works. Build a portfolio of 50 stocks, diversify away risk, and diversify away return. Our job is to focus on companies where the return compounding engine, which is what we are staring at, the free cash flow piece, the return compounding engine has to be firing at a high potency, 25% ideally, so that you make money without taking undue risk. We can obviously diversify away risk, but the traditional Indian way to diversify away risk is also to diversify away return. The goal is to have an Olympic contingent which has 100 people, out of which 3 come home with gold medals, not the traditional Indian event visit to the Olympics with hundreds and hundreds of people rocking up with not one goal to show for decades on end.
Cool. So last question on valuation is around the effect of interest rates or your discounting rates on the discounted values, given that we perhaps we don't know, but at least if you assume that interest rates are finally likely to rise. We've had almost 3 decades of falling interest rates globally. If we have interest rates rising up, how sensitive is that, those DCF charts that you showed to rising interest rates? And particularly so, if you're investing in companies with longevity, which are typically long duration assets, long-dated cash flows. Long-dated cash flows obviously will be affected that much more by discounting. What's our take on the performance of such companies in a rising rate environment?
Rakshit, if you don't mind, I'll take this.
Take it.
So folks, when you do DCF, when we do DCF, the denominator, the discount rate is supposed to be WACC, right? Weighted average cost of capital. WACC, weighted average cost of capital, is a blend of cost of equity and cost of debt, right? The companies we are investing in don't really have debt. So barring the banks and NBFCs in the portfolio, none of the rest are borrowing in the money market or borrowing from banks, right? So the companies we are investing in, their cost of equity is their WACC is fundamentally cost of equity. Now, cost of equity doesn't move when the Federal Reserve moves rates by 100, 200 bips. Cost of equity is best thought of as the opportunity cost for you to deploy money, right? So when you're doing a DCF on Asian Paints, it's not Asian Paints' cost of equity that you call them up. You don't sort of call up a hotline number and ask Asian Paints, what is your cost of equity? You ask yourself, what is the cost? What is the opportunity cost to me of investing in Pidilite or Asian Paints or HDFC Bank? Now, assume that, say, for someone like me, the opportunity cost is around 12-13%, right? So 12-13% is my cost of equity. Since Asian Paints is not taking on any debt, right? There is no debt to be considered. And my discount rate on my DCF for Asian Paints is 12-13%. It was 12-13% 2 years ago. It's highly likely to be 12-13% 2 years hence. The Federal Reserve's moving rates or the RBI's moving rates is not something that has a material bearing on Asian Paints' cash flows. The RBI moving rates is not something that has any bearing on Asian Paints' profits. And therefore, in the way we value, the way you should value an Asian Paints, the Federal Reserve piece, the interest rates piece doesn't have a material role to play here, right? But the perception that's built up that somehow this is important, right, is very powerful, right? The brokerage community has managed to convince people that when rates go up in the United States and when rates go up globally, there'll be a stock market, there is a stock market correction, and high quality stocks get hammered disproportionately. On both counts, that point of view is incorrect. And it's actually quite easy to show using data that in both counts, it's incorrect. So first of all, let's start with the broader stock market. In the last 70 years, right, since the Second World War, there have been, I think, around 12 instances. In the last 70 years, there have been 12 instances of rate rise cycles from the Federal Reserve. The American stock market has been in a bull market in 11 out of those 12 instances. So 12 rate rise cycles in America since the Second World War. Out of those 12 rate rise cycles, 11 have been periods of rising markets. Typically, when the Fed hikes rates, the US stock market compounds at 10% per annum. If you look at the rate hike cycles this century, 2004 through to 7, 2015 through to 17, right? 2004 through to 7, the Fed hiked by around 200 bips. 2015 through to 17, the Fed again hiked by around 200 bips. In both of those rate rise cycles this century, the S&P 500 rallied by 50%, 50%. Now let's come to India. Every single rate hike cycle in India this century has coincided with the Indian stock market rising. Typically, when the RBI goes into a rate hike cycle, the Indian stock market compounds in the mid-teens, which is only a little bit higher than its long-term average, right? So this point of view that rate rise cycles lead to discount rate going up and somehow the market corrects has no theoretical basis, and it has no data-oriented basis. It's a broker-created fantasy. Now let's come to the notion that in rate hike cycles, high-quality companies like a Pidilite, like a Titan suffer disproportionately. Let's look at the data again, right? In this century, 22 years, we are 22 years into the century, we can look at CPI inflation every single month. Around 40% of the months in this century, India has had CPI inflation higher than 6%. As we showed in our blog 2 weeks ago, when CPI inflation is above 6%, high quality companies, which means companies with pricing power, such as the companies we've been discussing in the past are, when CPI inflation is above 6%, high quality companies' top line grows 3 percentage points faster than the Nifty. Their operating profit margins actually expand, whereas the Nifty's operating margins shrink when there is high levels of inflation. And therefore, when CPI inflation is above 6%, high quality companies beat the Nifty by a clean 10%, right? And that logically makes sense. I think the blog is being projected. Yes, that's the table, right? So that logically makes sense that if you have petrochemical prices going up, will some unknown paint company from Ulhasnagar be able to hike prices, or will Asian Paints be able to deal with it better? As Rakshit showed you in his last CCP webinar, every single occasion, crude prices have doubled this century. Asian Paints has protected its gross margins and operating margins, right? At one level, common sense, the market leader, whether it's a Titan or a Pidilite or Asian Paints, protects margins better when raw material cost inflation is higher. Because they protect margins better, naturally, as you see in that table that's been projected on the screen, quality companies beat the Nifty by 10%, when there is higher inflation than normal, higher than 6%, when rate hikes typically take place. So on both counts, right, a false narrative is sold to the public. One, that bear markets begin when the Fed starts hiking. That's obviously rubbish at many levels. 2004 to 6, 2015 to 17 being the most recent Fed hike cycles, and each of them was a 50% rally in the S&P 500. And the second myth that is sold is when there are rate hike cycles, high quality companies suffer. That too is a lie. It's based on fiction rather than any grounding in fact.
Okay, moving to questions on capital allocation. There's a question on acquisitive. We've shown that many CCP companies in the past have been very acquisitive, but history says M&A is risky. In fact, 8 or 10 acquisitions fail. Somebody's even pointed out that Asian Paints has invested in home decor companies like Sleek and Bath Fittings, which haven't particularly worked out. Why are we so excited about these companies making acquisitions?
Right. So that's a very valid point that more often than not in India in particular, and even on a global landscape, acquisitions have been value destructive in the long run than value accretive. However, that doesn't happen always, and hence it's better to sort of analyze, understand the quality of capital allocation decisions made around acquisitions by any investor's portfolio company. In this case, just to give you a sense, what most of these companies do is, first and foremost, they don't acquire in areas where they can't add significant value. If they do so as an experiment, they allocate an insignificant amount of capital towards that acquisition. So take, for instance, a few examples. So Asian Paints, the Sleek SS acquisitions carried out 9 years ago, were less than 200 crores of capital employed, which even then was less than a sixth of the operating cash flow of 1 year prevailing at that time. Of today's operating cash flow, that's less than 1/10 of a single year's operating cash flow. After those acquisitions were made, there was a very long period of, you can call it gestation, or trying to create competitive advantages out of the acquired asset before more capital was allocated towards those acquired entities, right? So there was not even a single rupee of incremental capital deployed towards Sleek or SS for 9 long years before Asian Paints realized the way to make money profitably, consistently out of those acquisitions, right? Why are they doing these home decor acquisitions? The way we understand it, they're actually transitioning into a labor-oriented value-added services company. Today, whether it be a paint project, a carpenter project, or any other home decor-oriented project, the proportion of labor cost in the whole project cost has increased to 60, 70, 80%. In those projects, the proportion of material, paint material, plywood, laminates, adhesives, that has gone down significantly over the last couple of decades because of the rate at which labor cost has increased versus the rate at which material cost has gone up. And actually, material cost inflation has been curtailed by the companies such as Asian Paints and Pidilite because these companies, they avoid price hikes in order to strengthen their businesses. Now, what Asian Paints is, in our understanding, trying to do is they are organizing architect as a community. They are organizing contractors as a community, and that unorg to org shift in project execution that they can deliver through home decor, particularly beautiful home service, is what they're after. We don't see Asian Paints as becoming a competitor to Havells by selling their acquired entities products through dealers and distributors on the high streets of this country. That will be the case. That's sort of a business model, but it will be a minority of the value that Asian Paints is trying to add, the way we understand, through the home decor business. The majority is not via selling to a distributor or a wholesaler. It's actually via becoming part of the entire contractor or architect's project and then getting value out of the control on that whole project through services such as Beautiful Home Service, and color consultancies, and Asian Paints Home Solutions, and so on and so forth, right? So that's particularly on Asian Paints, but likewise on, say, a Pidilite. The kind of acquisitions that Pidilite did 12, 13 years ago were actually value destructive. At that time, we wouldn't have been excited about those acquisitions, because they were in areas which were not of core competence for Pidilite, and the size of those acquisitions was large enough for the overall return on capital employed to get diluted significantly in 2008, 2009, 2010, if those acquisitions didn't fire. And some of them didn't fire, and hence there was actually a massive adverse impact on not just the fundamentals, but also the share price of Pidilite. That's not the case when they've acquired Araldite. Right? That's not the case when Dr. Lal acquired Suburban, because remember, here, the Suburban acquisition, first of all, has not called for an incremental addition to the capital employed of Dr. Lal. It has, in effect, used its existing cash to acquire Suburban. What Suburban provides is a foot through the door into Western India geographies, where healthcare as a concept is very difficult to expand organically, right? Because it takes a very long time to build trust with a customer who has not yet experienced or build trust in let's say Dr. Lal's services in West India or South India, and hence it'll be a long drawn effort to grow organically across geographies with high returns on capital employed. The acquisition of Suburban, it fast tracks the ability of Dr. Lal to sort of build a hub and spoke in Western India without destroying return on capital employed, right? So those are the kinds of examples, and hence we are confident on the value add that these acquisitions will provide. But otherwise, yes, the person asking this question is right. There are many other acquisitions which have actually destroyed value for shareholders in the past.
And the person who's asking this, you should read the book called The Outsiders by William Thorndike. So it's a book written about 7 American companies, which over 50 years generated shareholder wealth, I think 20x that of GE, and this was GE in its form. And a lot of that was acquisition. So America, or in India, 80% of M&A destroys value. But this guy, William Thorndike, a private equity fund manager, he analyzed in detail the 7 most successful capital allocators in American history. And there are certain traits which are common to great capital allocators, whether it's in America or in India. And just as 90% of fund managers trail the index, it's that 10% that you are looking for, we are looking for, we're looking to become, you're looking to invest in. Similarly, in M&A, 80% of M&A destroys value, but that 20% which creates value results in remarkable companies. There's one such company called Berkshire Hathaway. You might have heard about it. It's created a lot of value in the last 50 years.
Thanks, Saurabh. So while we are on M&A, we'll answer the most frequently asked question in this session. In fact, one of the people who asked this question is Mr. T.S. Subramaniam from Ghaziabad. And he's asked, what is our take on HDFC Bank and HDFC Limited merging with each other?
Lakshya, you want to go first?
Yeah, sure. So look, operationally speaking, there are significant benefits which add to the runway of growth, add to the rate at which there will be growth of the combined entity. So to put some numbers in context, first of all, there about 70% of HDFC Limited customers don't have an HDFC Bank account. So there's a massive opportunity to cross-sell CASA to HDFC Limited customers. There's another 70% of HDFC Bank's customers who don't have mortgages. There's a good opportunity to sell mortgages from HDFC Limited to HDFC Bank, and hence the cross-sell upsell opportunities of the combined entity are far stronger than what they would have been with just a sort of a partnership as two separate entities that they might have with each other. So that's one. There's the second piece where there are two offsetting factors around net interest margins. So the HDFC Limited book is currently running a cost of funds which is around 250 bips higher than the cost of funds of HDFC Bank, and hence as more and more CASA funded liabilities franchise runs the book of HDFC Limited's acquired asset. There's margin expansion there. They will be offset from PLR, priority sector lending requirements, CRR ratios, etc., which banks have to adhere to, that an NBFC doesn't have to adhere to, and hence that will offset some of this 250 basis points margin. So those are a little bit of offsetting factors, but net we expect this to be accretive. And then there's massive value add to be had from group entities as well. So HDFC Life's products being cross-sold through the combined entities branches in a much more aggressive manner than they would have without these entities being merged together. HDFC AMC's products being cross-sold, so on and so forth. So that's a third dimension from group entities. Right, so on and so forth. So that's the operational piece that can add massive value. There are a few sort of relatively smaller risks to the quantum of value add from this merger, around say the amount of stake that will be allowed by regulators in some of the group entities, or around some of the parts of HDFC Limited's acquired book, and the quality of that book, and the impact that it might have on GNPAs of that acquired asset book of HDFC Limited, etc. So those are a few smaller offsets, but net, I think it's a development which adds more value to an otherwise high quality bank that we had held on to.
So just a little bit of a flashback. So we published Unusual Billionaires in 2016, right? So we were researching Unusual Billionaires in 2015 and had gone to sit down with Mr. Puri to interview him for the Unusual Billionaires. And I remember Sashi was also Sashi Jagdishan ji was also in that meeting. And as the conversation sort of got along, obviously the question came along as to in what circumstances would HDFC Bank and HDFC Limited integrate, right, or merge. And remember the context, right? Aditya Puri did a famously successful merger, one of the most successful mergers in Indian history, HDFC Bank, Centurion Bank of Punjab. Centurion Bank in turn was a result of a merger, and HDFC Bank transformed itself back in, I think, 2004 with that transformational merger, and all credit to Puri Saab for pulling that off. So with that sort of background, we were discussing in what circumstances would he find the merger to be a good idea. And the first subject which came up was obviously the swap ratios would have to be fair. And our reckoning is what was announced earlier this week. The swap ratios are fair. Basically, we as HDFC Bank shareholders have relinquished 20% of our ownership in HDFC Bank in order to own HDFC Limited. So first thing was swap ratio should be fair. Secondly, he raised the problem of CRR, SLR, as KK Mistry and Deepak Parekh Saab have explained. With CRR, SLR being reduced in recent years, those problems are now of a lower order of magnitude than was the case when back in 2015 I was having this chat with Aditya Puri and Sashi Jagdishan. And the third point was the cross-sell point, right? He believed, and I think rightly so, enormous wealth creation in selling home loans to HDFC Bank customers. And for validation of that, just look at ICICI Bank. ICICI Bank's renaissance largely has been around selling home loans. Home loans are attractive, low NPA, sticky products. HDFC Bank never had the advantage of it. Just in retrospect, think about it, right? This bank in the last 27 years has created enormous amounts of shareholder wealth without ever having the privilege of being able to have home loans on their book. Home loans is one of the most potent things in a good quality Indian bank's armory, long dated assets, low NPAs, long customer lifetime value. So there was obviously synergy. And the other piece was to HDFC Limited customers, the bank would be able to sell an array of other things. So harking back to that chat 7 years ago with the great Aditya Puri, what's been done earlier this week seems like the sort of deal the great man would have approved of. And talking about capital allocators and CEOs who created wealth through acquisitions, I don't think you can talk about someone any better than what Aditya Puri did with the Centurion Bank of Punjab deal.
Fair enough. Just last couple of questions. There are a couple of stock-specific questions, I think repeatedly asked. One is around the free cash flow growth. Not all CCP companies have had a 20% plus free cash flow growth, even if you take the last 10 years. For example, Nestle and TCS. How do you justify that? And do their existence in your portfolio mean that free cash flow growth will revert to 20% plus over the next 10 years?
Right. So, yeah, I mean, when you look at Nestle in particular, over the last, say, 10 years, the 12% number, it has two parts to it. One, over the last 10 years, the first half of the last 10 years was a period where the company actually was a little bit undergoing a moderation in its or deterioration in its competitive advantages. The degree of price hikes being taken made the products significantly more expensive, particularly in child nutrition, etc., and that was having an adverse impact on volume growth rates across the portfolio, and even operating efficiencies wasn't as powerful a driver of value at that time. When you look at the last 5 years, there's a little bit of a point-to-point issue, which is best looked via the earnings growth of FY 16 to 21. So the gap between earnings growth of 16 to 21 and free cash flow growth of 16 to 21 actually is because of a point-to-point issue where more recently Nestle has done a massive capex to expand capacities, and this does lumpy capex. In FY 21 there was one such, because of which the point-to-point effect is leading to a relatively low number. But otherwise, operating efficiencies every year, the EBITDA margin pretty much in the last 4 years, every year the EBITDA margin has gone up by around 150 basis points roughly, because of increased automation, because of improved labor productivity, and at the front end, a lot of sort of slack which existed in Nestle's business till 5-6 years ago, we've seen being removed by the new management under Suresh Narayanan. So that's what gives us the conviction on Nestle. On TCS, I mean, one of the reasons why we didn't hold on to TCS till 2-3 years ago was pretty much same as the reason why you're asking this question. Till a couple of years ago, TCS wasn't as sweetly positioned as it is today in terms of the tailwinds and the benefits of those tailwinds on the supply side aspects of their project execution, where with all sort of applications at a corporate moving to cloud and consolidation of vendors happening because all the data sits at one place and the entire firm feeds off a common centralized way of running tech as a resource, tech as tools. You need consolidation of vendors for corporates, and that calls for large-scale manpower-oriented IT vendors benefiting over other IT vendors which cannot provide large-scale manpower at cheap prices, which is where Tata Consultancy is in the best position compared to competition. And hence our conviction levels going up more recently, because of which we added TCS to the portfolio. So yes, historically, last 10 years, the free cash flow compounding has been 22%, not weak, but the last 5 years it had been 15%. We expect reversion to sort of 20% plus in future, and hence we are holding on to TCS.
Great. Last question from Mr. Subramaniam from Ghaziabad again. Most mutual funds have all of these companies. Why should I invest in CCP?
Right. So quick quantifiable ways to answer that. It's a concentration of the portfolio which drives the weighted average at the bottom, right? Other mutual funds which have this list also have another list of 20 stocks, which I think Saurabh also previously mentioned. It leads to dilution in the rate of return, quality of return, and that quote unquote diversified mutual fund, which also has all these 14 stocks, is not going to give you an adequate return. That's one. Secondly, not just concentration, it's also position sizing, which adds value to such portfolios. And position sizing includes the benefits such as, let's say, the ones that we had more recently from a rebalancing activity that we carried out when Page Industries and Titan went up in the last 6 months quite significantly, and stocks like, say, Dr. Lal Path Labs, HDFC Life, they went down quite significantly. Across all portfolios where Dr. Lal Path Labs is owned, let's say Rising Giants, here consistent compounders, etc. Our fund managers have tried to benefit from this sort of a dislocation. This benefit from dislocation is very similar to what we did 2 years ago with Bajaj Finance. It paid off very nicely in returns for the overall portfolio when Bajaj Finance recovered after rebalancing in a much faster manner than the rest of the portfolio. And our purchase of 6 percentage point extra in Bajaj Finance 2 years ago over the last 2 years has given a very healthy outcome to our overall portfolio performance. Dr. Lal already, I mean, we bought at around 2,400, 2,300, that sort of a level for some of our clients where the dislocation had emerged in a very meaningful manner. And for those clients, we have seen already a massive benefit, and we expect to see more such benefit for as Dr. Lal sort of mean reverts towards fundamental rate of growth versus what it has been doing as a share price of the last 12 months. So those are the benefits why you come to us. It's not just the list of these 14 stocks, it's the whole portfolio construction approach and the way the portfolio is managed, and the conviction in only these companies, not another 30 mediocre quality companies to be held in the portfolio.
Thank you. Thanks, Rakshit. Thanks, Saurabh. Thanks, everyone, for dialing in. That's pretty much for now. We're 6:30. I'm sure there were a few other questions which were not answered, but we'll try and reach out to you individually and communicate the same. We'll try to answer as many questions as possible, and particularly those have been often repeated, so that people benefit more from understanding the philosophy than stock specific. Thank you very much.
Thanks, Pramod. Thank you.